The United States government has just revealed its hand. For the preceding 72 hours, investors had been fixated on the COMEX ticker, observing the price of silver battle fluctuate around $90. They had been meticulously analyzing charts, agonizing over price declines, and questioning if the upward market trend had concluded. However, while the general populace was engrossed by the market's on-screen fluctuations, the United States Mint, the authoritative body responsible for the nation's coinage, discreetly updated its internal pricing structure. The figure they published represents more than a mere price adjustment. It is an admission of a fundamental truth. We have received corroborating accounts that the U.S. Mint has re-established the price for its proof American Silver Eagle coins at $173. Furthermore, they have repriced the uncirculated bullion variant to $169. Take a moment to let this information truly sink in. The prevailing market price displayed on your screen is $90. The government's established price is $173. This signifies a premium of almost 100%. This is the sovereign's revelation, the moment where the very institution that issues the currency acknowledges that the currency itself is in a state of disrepair. Now, the skeptics will undoubtedly protest, asserting that the mint is currently non-operational and that sales are suspended, rendering this price immaterial. However, I am here to inform you that this development carries more weight than any other market event at this precise juncture. Why would a governmental agency currently declining to sell coins due to a pricing backlog proceed to nearly double the price within its system? They are undertaking this action because they are proactively confronting the imminent reality. They are acutely aware that when they eventually reopen sales, whether that occurs next week or in the following month, they will be unable to offer silver at $90. To do so would be to effectively give it away, to divest a strategic asset at a fraction of its true worth by setting a price of $173. The U.S. Mint is thus indicating its perception of the actual market clearing price. They are conveying that the paper price of $90 is an illusion, a fabricated construct divorced from the tangible cost of physical replenishment. This creates a bifurcated reality. In the first tier, you have the paper traders on Wall Street engaged in the exchange of digital contracts, perpetuating the notion that silver is valued at $90. In the second tier, you find the holders of physical assets, the mint itself, dealers, and industrial consumers who understand that acquiring tangible metal necessitates a significantly higher expenditure. This divergence is the very definition of a dysfunctional market. When the disparity between the paper price and the physical price escalates to $80, the exchange ceases to be a mechanism for price discovery and instead becomes an indicator of insolvency. Consider the psychological ramifications of this situation. If you are an individual investor witnessing the government setting silver's price at $173, would you be inclined to liquidate your holdings for $90? Absolutely not. You would elect to retain your assets to patiently await a more equitable valuation. You would recognize that your asset is worth considerably more than the amount the financial institutions are willing to offer. This dynamic fundamentally undermines the liquidity for short sellers. Financial institutions require you to sell so that they can cover their outstanding positions. Yet the U.S. Mint has effectively instructed every silver owner in America to firmly hold on to their assets. They have, albeit inadvertently, crafted the ultimate narrative for steadfast investors. Furthermore, let us examine the timing of these events. This repricing occurred on a Friday afternoon, immediately following a substantial and ultimately unsuccessful attempt to suppress the paper price. The banks attempted to drive the price of silver down to $86 but failed. The market concluded the week above $90, marking the first weekly close surpassing this threshold in recorded history. In direct response, the mint elevated its price to $173. This situation represents a conflict between the deflationary pressures exerted by the paper market and the inflationary realities of the physical world. The paper market advocates for lower prices to safeguard the value of the dollar. Conversely, the physical market demands higher prices to justify production costs. By setting the price at $173, the US Mint has unequivocally aligned itself with one side of this conflict. They have embraced the inflationary trend, tacitly admitting that the purchasing power of the dollar has eroded to such an extent that a single ounce of silver now commands nearly 200 units of currency. This is the tangible manifestation of a currency crisis unfolding in real time. It is not characterized by a sudden collapse to zero, but rather by a sequence of price adjustments where the cost of tangible assets escalates rapidly to reflect the devaluation of the currency. We are currently experiencing what can only be described as the Great Repricing. The displayed price indicates $90, while the mint asserts a value of $173. Which of these figures represents the genuine price? Is it the price at which one can acquire a digital contract, potentially to be settled in cash, or the price for a physical coin that can be held in one's hand? The answer is unequivocally clear. The physical price is the authentic valuation. The paper price is merely an expiring coupon. However, if the mint's repricing served as the initial signal, the events unfolding within the vaults on Friday represented the decisive action. Concurrent with the mint's website updates, a significant outflow of silver from the commercial vaults at the COMEX exchange was underway. We have documented one of the most substantial single-day withdrawals in the exchange's history. In the subsequent segment of this in-depth analysis, we will dissect this Friday night acquisition. We will meticulously examine the data, revealing that over 4 million ounces of silver were removed from the COMEX exchange within a single trading session. We will elucidate the rationale behind the bank's aggressive price reduction to $86, which was not driven by profit motives, but rather to facilitate this massive withdrawal. They strategically lowered the price to enable them to acquire the metal from the vaults at a reduced cost. The mint has illuminated the intrinsic value, while the vault activity has exposed the scarcity. Taken together, these developments indicate that the established financial order is nearing its conclusion. While the United States Mint was occupied with updating its website to reflect a $173 price point, a distinctly different operation was transpiring within the clandestine recesses of the financial system. We have meticulously analyzed the daily warehouse reports issued by CME Group for Friday, January 16th. Typically, these reports are rather uneventful, detailing minor movements of precious metals into and out of the vaults, perhaps a few thousand ounces here and a few thousand ounces there. However, on that particular Friday, the report was indicative of a bank run. Within a single 24-hour period, an astonishing quantity exceeding 4.22 million ounces of silver was physically withdrawn from the COMEX vaults. To provide some context for this remarkable figure, 4.2 million ounces equates to approximately 130 metric tons of silver. This is not the purchase of a few coins by an individual investor, nor is it the procurement of supplies by a jewelry manufacturer for the quarter. This represents a fleet of armored vehicles, a cargo plane, a strategic exodus of monumental proportions. It is imperative to examine precisely which depositories experienced these withdrawals. The data is highly specific. 1.4 million ounces were removed from the Asahi depository, 1.22 million ounces from the CNT depository, an additional 1.2 million ounces from the JP Morgan vault, and nearly 800,000 ounces from Manfra, Tordella, and Brooks. This was a coordinated systemic raid across every major custodian within the COMEX network. And here lies the irrefutable evidence. This withdrawal occurred on the identical day that the paper price was aggressively driven down to $86. Do you genuinely believe this to be a coincidence? Is it plausible that the price dropped by $6 precisely before 4 million ounces were removed from the premises? Absolutely not. This was an orchestrated heist. The banks engineered this flash crash to $86 for a singular self-serving objective: to settle their physical withdrawal requests at a substantial discount. For an entity withdrawing 4 million ounces, a mere $6 reduction in price translates into a saving of $24 million. They deliberately manipulated the price to facilitate the plundering of the vaults. However, the most alarming figure within this report is not the total withdrawal volume, but rather the precipitous decline in registered silver. Within the COMEX system, registered silver refers to the metal that is readily available for delivery against futures contracts. It represents the inventory explicitly marked as available for sale. On Friday, the registered category experienced a dramatic decrease of over 2.5 million ounces, falling to a mere 120 million ounces. This represents the market's buffer, its safety margin, and it is rapidly evaporating. When the quantity of registered silver diminishes at such an accelerated pace, it signifies that the owners of this metal, the banks and trading houses, are removing the for sale signs. They are relocating this metal into private hands, effectively removing it from the open market. What would motivate such an action, particularly when the price is approaching historical highs? The answer lies in their awareness of impending events. They are cognizant of the Trump proclamation and the ongoing Section 232 review. Should the United States government decide to classify silver as a critical mineral and implement price floors or impose export restrictions, it would be highly disadvantageous to have one's metal held in public vaults within New York. Such assets would be far more secure in private vaults or ideally outside the country altogether. We strongly suspect that a significant portion of these 4 million ounces is being transported to London or Shanghai. Reports indicate that the London Bullion Market Association, the LBMA, is experiencing dangerously low levels of available silver. The arbitrage differential with Shanghai is draining London just as rapidly as it is depleting New York's reserves. The banks are engaged in a game of whack-a-mole, siphoning metal from the COMEX to address shortages in London. They are essentially robbing Peter to pay Paul, but in this analogy, Paul is already bankrupt. This transfer of wealth from public markets to private holdings represents the final phase of a significant market squeeze. When you observe 4 million ounces being removed in a single day, you are witnessing the demise of market liquidity, the slamming shut of the exit door. This brings us back to the United States Mint's pricing of $173. The Mint is fully aware that the vaults are being depleted. They understand that if they were to attempt to acquire 4 million ounces to fabricate coins, such a procurement would be impossible. The necessary metal simply does not exist. It has already been allocated. Consequently, we are confronted with a scenario where the paper market assigns a value of $90 to silver, while the physical inventory underpinning this market is disappearing at a rate that virtually guarantees a default. If the COMEX exchange continues to hemorrhage metal at this rate, 4 million ounces daily, the registered inventory will be completely depleted within 30 trading days. 30 days. This time frame precisely aligns with the March delivery month. Historically, March is a period of substantial silver deliveries. Open interest data suggests that traders are standing for delivery in record-breaking numbers. They are actively rolling their contracts backward, as previously discussed, to secure immediate physical possession of the metal. However, if the banks drain the vaults in January and February to facilitate shipments to China, what will be available for delivery in March? There will be nothing left to deliver. This constitutes a force majeure scenario, the moment when the exchange declares its inability to fulfill its contractual obligations. It is the point at which they inform contract holders that regrettably the silver is unavailable and offer a cash settlement instead. Yet, as we well know, industrial consumers do not desire cash. They require physical silver. Therefore, the Friday night acquisition was not merely a financial transaction, but a potent signal that the informed insiders are capitalizing on favorable conditions while they last, effectively withdrawing their capital from the game. For the retail investor, this represents the most urgent warning imaginable. The banks are actively taking possession of physical assets, the government is suspending sales, and the vaults are rapidly emptying. If the world's most influential players are aggressively acquiring tangible metal and exiting the market, why would you continue to hold paper assets? The grand repricing is not solely about an upward price movement. It is about the complete depletion of availability. In the subsequent analysis, we will examine the retail investor surge, and while the major players were orchestrating raids on the vaults on Friday, the retail public was engaged in an equally historic undertaking. Data compiled by the Quebec Letter indicates that retail investors have consistently purchased silver exchange-traded funds, ETFs, for 169 consecutive days. This represents an unstoppable force encountering an immovable object. The retail investor community is actively acquiring paper claims on silver precisely at the moment when the physical silver is being systematically withdrawn from the system. We will meticulously analyze this convergence and explain why the ETF market is a trap and how the staggering 4.4 billion ounce short position held by institutions like Citibank and Bank of America is poised to lead to their imminent downfall. The vaults are depleted, the collective sentiment is one of growing agitation, and the short sellers find themselves ensnared. We have witnessed a sovereign default at the US Mint and a bank run at the COMEX vaults. However, a third, perhaps the most unpredictable force, exists within this market: the general public. For an extended period, the silver market remained a relatively secluded domain, populated by contrarian thinkers, survivalists, and advocates for sound money principles. Yet over the past 6 months, a significant shift has occurred. The psychological disposition of the average investor has undergone a transformation. We have recently received data from the Kobesai Letter, a highly respected institutional analysis firm, which substifies a buying frenzy of unprecedented historical magnitude. Retail investors have consistently been net purchasers of the largest silver ETF, SLV, for an unbroken period of 169 consecutive days. This represents nearly 6 months of relentless, unceasing accumulation. It is the longest sustained buying streak on record. In the last 30 days alone, silver ETFs have experienced inflows exceeding $920 million. The current buying activity is more than double the average observed over the preceding 3 months. To put this into perspective, the buying pressure currently being exerted has officially surpassed the peaks witnessed during the silver squeeze of 2021. At that time, the movement was characterized as a flash mob orchestrated through online platforms like Reddit. While vocal, its duration was brief. This current situation, however, is fundamentally different. This is not a mere flash mob. It represents a migration of capital. It signifies capital that is exiting the stock market and bond market, seeking refuge in tangible assets. Yet the tragic irony of this scenario lies in the fact that this substantial influx of capital, amounting to billions of dollars, is being directed into an inappropriate investment vehicle. The majority of these funds are flowing into paper-based ETFs, such as SLV. The retail investor operates under the misconception that by purchasing SLV, they are, in effect, acquiring silver and removing physical metal from the market. This assumption is erroneous. When you purchase a share of SLV, you are not acquiring a physical bar of silver. Instead, you are obtaining a trust unit that represents a claim on a silver bar situated within a vault managed by JP Morgan. This is the same JP Morgan whose vaults we have just observed being systematically emptied. This creates a conflict of interest of such immense proportions that it is virtually insurmountable. The entity entrusted with the custody of the silver is simultaneously the largest short seller of that very silver. This brings us to the antagonists in this narrative. We have received reports indicating that major financial institutions, specifically Bank of America and Krupp, are holding a substantial derivatives portfolio. Some financial analysts estimate their gross short position in precious metals to be as high as 4.4 billion ounces. Let us perform a simple calculation. The global annual silver mining production is approximately 800 million ounces. These banks have issued paper contracts representing 5 years' worth of total global production. They have effectively sold silver that does not physically exist and silver that has not even been discovered yet. This is the quintessential definition of a naked short position. And now they find themselves in a precarious predicament. On one flank, they face the relentless surge of retail investors pouring billions of dollars into the market, driving prices upward. On the other flank, they are confronted by the major players systematically draining physical vaults, thus depleting the collateral that underpins their positions. They are caught in an inescapable bind. Should the price of silver ascend to $100, the losses incurred on a 4 billion ounce short position would be catastrophic. Such an event would obliterate the equity of these banks, necessitating a bailout from the Federal Reserve that would dwarf the scale of the 2028 financial crisis. This situation meticulously explains the violent fluctuations in market prices and the aggressive attempt to drive the price down to $86 on Thursday. They are engaged in a desperate fight for survival, yet the retail surge continues unabated. 169 days of consistent buying demonstrates that the public is not divesting during price dips. They are actively purchasing them. Each instance where the banks attempt to suppress the price, the inflows into ETFs accelerate. The banks are attempting to deter the public, but their actions are inadvertently enticing them into the market at more advantageous prices. This is the unstoppable force meeting the immovable object. The unstoppable force is the inflation-averse public. The immovable object is the insolvent banking cartel. Something is inevitably bound to yield. And based on the vault data presented in Part 2, the element that is yielding is the physical inventory. The ETF structure functions as a temporary buffer, absorbing retail demand and temporarily shielding the physical market. Authorized participants can employ leasing arrangements and accounting maneuvers to comply with ETF regulations without physically moving the metal. However, this is not a sustainable solution indefinitely. Eventually, the discrepancy between paper claims and physical reality becomes too significant. If an ETF like SLV purports to hold 500 million ounces, but the physical vaults are empty because the silver has been rerouted to Shanghai, the ETF is destined for implosion. We are rapidly approaching a critical juncture where the number of paper claims will exceed the actual physical silver by a ratio that will trigger a default. For the individual investor, this data carries a profound and stark warning. If you are participating in this 169-day buying streak and hold SLV, you are positioned in a high-risk zone. You are essentially holding a receipt for a vehicle that has already been stolen. When the market squeeze ultimately overwhelms the banks, the ETFs will likely be settled in cash, meaning you will receive dollars. However, your objective is not dollars. It is silver. The retail swarm has grasped the correct underlying objective to acquire silver, but their execution is flawed. They are purchasing a representation of the asset rather than the asset itself. This massive influx of capital unequivocally demonstrates a fundamental shift in market sentiment. The public is now informed and aware. They understand the declining value of the dollar and the insidious nature of inflation, and they are expressing their convictions through their financial decisions, albeit within a manipulated system. The Friday night heist, which we detailed in Part 2, represented the astute investors securing physical metal before the ETF holders even realize its absence. So, what does this portend for the Monday market opening? We are facing a market where the prevailing price is $90. The Mint's valuation stands at $173. The Shanghai price is $12, and the banks are engaged in a 4 billion ounce short position. This is a volatile situation, akin to a powder keg. The retail buying activity serves as the fuse, the depletion of the vaults acts as the spark, and the inevitable explosion will result in a repricing of silver to a level that rectifies the imbalances. That level is demonstrably not $90, nor is it $100. In the concluding segment of this comprehensive investigation, we will present our final assessment. By integrating the US Mint's pricing, the vault depletion data, and the extent of the short positions, we will calculate the definitive target price. We will also address the impending Monday price gap. Given the magnitude of news breaking over the weekend, the US Mint's repricing, and the vault depletion, the market is likely to experience considerable volatility upon opening. We will subsequently provide you with a definitive strategy for navigating this period of significant price adjustment. The banks are trapped, the public is aggressively entering the market, and the physical metal has vanished. The only conceivable path forward is upward. We have reached the culmination of our investigation. If you have followed this forensic examination, you now possess an understanding of the market dynamics that the mainstream media deliberately obscures. You comprehend the sovereign leak, where the US Mint tacitly acknowledged the true price to be $173. You understand the Friday night heist, during which over 4.2 million ounces were plundered from the vaults, and you grasp the retail swarm, which has effectively trapped the banks in a 4 billion ounce short position. The evidence is overwhelming and irrefutable. This is not a theoretical construct, but a profound mathematical discrepancy that cannot be resolved without a substantial repricing event. Today, Saturday, January 17th, 2026, we stand at the precipice of the most significant pricing anomaly in the annals of financial history. Let us review the figures one final time. The spot price on the COMEX closed at $90.14. The Shanghai price concluded trading at $12. The United States Mint's effective price is $173. The disparity between the paper price in New York and the sovereign price at the U.S. Mint is $83. This is not a mere spread. It is a chasm, a veritable Grand Canyon of financial risk. If you have the ability to purchase silver for $90, representing an asset that the government itself values at $173, you are presented with the investment opportunity of a lifetime. You are effectively acquiring dollars at a 50% discount. However, this profound imbalance cannot persist indefinitely. Markets abhor a vacuum. The laws of physics demand equilibrium. There are only two plausible resolutions to this widening gap. Scenario 1 posits that the U.S. Mint is mistaken, that the perceived shortage is illusory, and that the 4 million ounces will be returned to the vaults, causing the price to revert to $90. Given the data we have analyzed, the inelastic industrial demand, the depleted mining reserves, and the widespread retail hoarding, this scenario is demonstrably impossible. The metal is gone, and it is not expected to return. Scenario 2 proposes that the paper price on the COMEX will experience a substantial upward surge, aligning itself with the physical reality. This represents the only viable path forward. The paper price consistently lags behind physical market movements. It is the last element to adjust. The physical price dictates the trend, the Shanghai price confirms it, and eventually the paper price capitulates. We are poised for a significant shock on Monday morning. While the financial markets remain closed throughout the weekend, news of the U.S. Mint's repricing and the extensive vault depletion is rapidly disseminating. Investors across the globe are engaging in the same calculations that we have just undertaken. They are recognizing that $90 represents an extraordinary bargain. As trading commences in Asian markets on Sunday evening and in New York on Monday morning, anticipate a surge in demand for liquid assets. We foresee market participants attempting to preemptively secure supplies from the U.S. Mint. If the government's valuation pegs silver at $173, then figures like $95, $100, and $120 become exceptionally attractive. This dynamic fosters a buying frenzy that overwhelms the financial institution's price stabilization mechanisms. Therefore, what is the ultimate conclusion? The definitive outcome is that the significant revaluation has commenced. The era of silver prices in the single digits has essentially concluded in tangible reality, even if digital platforms have yet to fully reflect this shift. The crucial determination is that the banking sector has relinquished its command over physical inventories, signifying a loss of influence over pricing. They possess the ability to generate fiat currency, but are incapable of manufacturing precious metals. Consequently, we are observing a redistribution of wealth from those who place faith in digital readouts to those who value tangible measures. So what is your approach? How will you navigate this turbulent period? The foremost directive: refrain from liquidating your physical holdings of precious metal. The temptation to do so will undoubtedly be substantial. Should silver reach $100 next week, a feeling of affluence might ensue, prompting a desire to realize gains. However, recall the stated price from the U.S. Mint. If you divest at $100, you are effectively accepting a $73 deficit compared to the government's acknowledged worth. You are being significantly shortchanged. Avoid exchanging your scarce commodity for a depreciating currency. Maintain your position until the paper price aligns with the real-world market value. The second principle: disregard the price fluctuations. While the major financial players are weakened, they are not defeated. They will likely attempt to artificially depress the market value once more. Their objective might be to drive the price down to $88 to trigger automated stop-loss orders. If you observe a sharp decline on Monday, dismiss it. It represents a deceptive indicator, a manipulation of the paper market. The authentic competition unfolds in secure storage facilities, and those facilities are depleted. The third tenet: monitor the differential. The most critical analytical tool presently is not the nominal price of silver, it is the disparity between the quoted spot rate and the price for physical delivery. As long as this gap persists, as long as the mint's price exceeds that of the commodity exchange, the upward trend remains robust. The short squeeze is actively in progress. We are bearing witness to the unraveling of a half-century-long strategy to suppress the valuation of sound money. The process is disorderly, marked by instability and apprehension. However, it also represents an unparalleled opportunity of our lifetimes. The United States government has inadvertently revealed its hand, disclosing its perception of silver's true worth. They have indicated that its value is $173. Place your confidence in their assessment. The banks are heavily short. The mint has ceased sales. The storage vaults are empty, and the price is $90. You are aware of the appropriate course of action.